Hello everyone, this is Bella. Welcome to the next installment of my series of price behavior teaching sharing videos. Through the study of the previous 10 courses, you should have mastered the basic K-line form and K-line combination, have the ability to simply read the strength of the market, and also recognize the common structural forms and simple corresponding roles in the market. But that alone is far from the point where you can make a solid profit on a trade. It's like when we were new to the game and just learned the MACD or the Fibonacci pullback and thought we had the market under control, but we can't even reach the threshold of a solid profit. No form can give us 100% success rate. The current highly optimistic form structure may no longer be favorable to us after a few K lines. Understanding and accepting the uncertainty of market movement and the changes between the form structure and make corresponding decisions will achieve what we often say is a thorough understanding. Today's video will mainly explain some basic rules of price movement to help you connect all the knowledge we have learned before and make reading charts easier and simpler. The original plan is to record several periods of chart reading teaching, which is to use the K-line playback function to explain the analysis logic and role of each key signal, K-line and price pattern, as we did before. But this kind of video takes a lot of time to record and the audience is very small and a very small percentage of the audience likes to see the logical reasoning of the price movement, which I think is the most important logical reasoning. In a word, it's very thankless, so I'm just going to make it clear that there are a few things that you need to pay attention to. We combined with the knowledge we have learned to copy reading figure practice, can master. So the first thing we're going to talk about in a little bit more detail is the fundamental principle of price movements in the market is uncertainty. You might call it multiplicity, and we've talked about that a lot in the previous videos, but we haven't really gone into the logic behind it. Uncertainty in price movements is the fundamental principle that underlies our technical analysis, and if we can't understand and accept that, then it's very difficult to get on the path to steady profit. But the reality is that most traders don't understand uncertainty, and many are still pursuing the holy grail of trading in the hope of learning a set of conditions 1, 2, 3, 4, 5 where you can make money if you follow them. To understand the uncertainty of price movements, we need to understand why prices go up and down, and it's very simple that there's more money to buy than to sell, and the price goes up than the money to buy and the price goes down. It's also very simple who determines the amount of money that is being bought and sold in the market, and all the participants in the market are making decisions based on their own analysis to buy or sell, and they are working together to influence the market price. Now let's step through the first question: who are the participants in the market? There is no simple answer to this question. There are different types of participants in the market. Some markets are dominated by retail investors and some by market institutions. Let's take a traditional large investment market where there are large investors, banks, hedge funds, and some small speculators as institutional players. They have different ways of participating in the market. Large investment institutions, because of their size, their entry and exit directly affect the price trend, so they prefer to operate prudently and make annualized returns on long positions, while small speculative institutions don't have to worry about these problems and they tend to operate more aggressively in order to maximize profits. There are even institutions that are not in it to make money at all. They are in it to hedge against their other risky assets. In addition to the institutional market, there are retail players like us, but there are many different types of retail investors who have the same amount of money as small institutions, or who are just playing around with a few $1,000s, or who have technical analysis expertise or fundamental analysis expertise, or who don't know anything and they just follow suit. Through thinking about the first question, we find that the composition of participants in the market is complex. It is not a simple opposition between institutions and retail investors. Different types of institutions have different purposes and will have different views on the market. Now that we know that the composition of the players in the market is complex, and on top of that, let's think about the second question: how do these different players analyze the market and make decisions? Because it's only after they analyze the decisions that the actual buying and selling of the money affects the price. It's also a very complicated question to answer, and let's start with the organization, and just to make it a little bit easier, we don't have to think about the size of the organization, but we have to talk about their analytical tools, and the analytical tools of the organization are not uniform, and some of them are fundamental, and some of them are technical, and some of them are mathematical and quantitative models. And he doesn't care about the fundamental and technical aspects of these three types of analysis, and then you can go further. Fundamental analysis can also be divided into industry outlook analysis, national policy analysis, corporate team ability analysis, financial data analysis, etc. I'm not very good at fundamentals. I won't go into details, so technical analysis will be more extensive. Large cycle average group trend trading to determine the market is overbought and oversold, to reverse trading to specialize in the analysis of high and low multiform structure price behavior in large shock ranges. There are all kinds of technical indicator models that the institutional teams develop themselves that we don't hear about, and so on and so forth. I don't know much about mathematical quantitative model, but what I do know is that over the past 10 years, the proportion of computer quantitative trading in the market has been increasing, and their quantitative model design is also various. I won't tell you much about the retail player. Most small retail players don't have an analytics tool, so basically they just buy whatever sector is hot, or a variety goes down from $100 to $10, and he thinks he's getting a good deal on it, whereas the professional retail player, they use analytics tools and institutions that are more or less through the second question. Right, and what we found was that participants used a wide variety of analytical tools, and instead of using one system and one metric as many people think, by where you go down sell, where you go up, this is a very wrong perception, and even if you apply the same fundamental analysis to national policy, some people will interpret it as positive and some people will interpret it as negative, and even if you apply the same technical analysis to tracking trends, it will be divided into radicals and conservatives who will make different decisions about the same price patterns. The third question is, what are the emotions of the different players in the market? And we all know that emotions can influence decisions, especially in situations of extreme panic, extreme greed, extreme hubris. It's even more complicated to interpret the emotions of each individual participant, and the human heart is hard to understand, and there are some organizations that specialize in market sentiment, and they take a lot of data like questionnaires and social media keywords and market valuations and so forth, and they put that data into their algorithms as a sentiment indicator. But even though they are professional organizations, they have more resources and technology than we do as individuals. The indicators that they come up with can only be a general statement of the current market sentiment, and the fact that when the indicators say extreme panic doesn't necessarily mean that prices have bottomed out. Extreme greed doesn't mean that prices are about to fall and then go up in a few days, and it doesn't happen before they go off the charts. So the question about market sentiment, although we know it's very important, but we can't accurately grasp the emotions of every market participant. So we can't accurately grasp the price movement through emotional research. Having said that, I believe many of you have some understanding of the multiplicity of price movements. The game between funds leads to the rise and fall of prices. The buying and selling of funds is based on the analytical decisions of each participant in the market. But there are many different types of participants in the market, and they are using a variety of analytical tools to make decisions. And we don't know exactly what the emotions of each individual participant are, and the combination of these factors makes it impossible to accurately analyze price movements, and there is no one person or institution in the world that can accurately predict price movements. Unless you're in a market with a very small market value and a very low depth, and these are the dominant, highly controlled stocks that go up and down as they say. As long as you're in a high market value and a high liquidity variety, then there must be multiple institutions playing the game, and there's price uncertainty. So let's take an example and get a feel for it. This is a 4-hour chart of crude oil. What would you do if you had this chart of the state of the market? There are currently 3 signature moves in the market: the upward false breakout below the trend and the verification of the support level. Different types of participants will have different analyses and decisions on the current chart status. Let me give you a couple of simple examples. If you are a short trader in price behavior and you see a sharp drop here and you hit a support level and you think that the short momentum may run out and you may form a trading band, and if the market gives a long entry K line you will actively participate, and the long entry K line is a different choice for every trader. Some people want to see a strong single K reversal, some people might wait for a second break, and some people might see this big negative line and think it's a short run out of momentum and just move in. The same logic of being long, everybody has a different entry. So let's say you're a reversal trader and you see a false break to the upside and you see a big break in the trend line and you think that's a potential reversal pattern, and when the price retreats to the previous high you're going to go short. Some people are going to start building positions in batches as they retract. Some people are going to wait for the retracement trend line to get involved, and some people are going to wait for the reversal line K near the former high to get in. So let's say you're a trend trader and we open up the EMA system, which is Vegas here, and you can see that this is a strong trend arrangement of the EMA, and you can see that this trend is healthy and it's just a complicated adjustment, and then it's going to continue. And you can find all kinds of bullish signals to get involved in the market and wait for a break in the trend direction. Here are just 3 examples. There are a lot of technical analysis tools, all kinds of metric systems that we haven't talked about, all these different kinds of analysis tools that are used by people, and as long as people are trading it affects the market. It's the same chart. It's the same market state, and everybody's going to have different opinions and different decisions, but who's right? Is it only the person who makes the right prediction and his logic is right? There's a misconception that we've talked about before about making trades called outcome preference, which is that you just look at the outcome of the trade and you don't think about the logic of the trade, and that's obviously not true. As long as you have the right analytical logic and the right entry position, you're going to have a good trade regardless of the profit or loss in the case that we just showed you. People in the same system look at the same chart and they all have their own trading logic and they're all right, and everyone can analyze that logic, but in the end the market is going to follow a template and somebody's going to win and somebody's going to lose. And why is that? Very simple. Even if there are all kinds of views on the market, but the final decision will be push everyone the power of the market. When money is due to a variety of logic to buy, then on selling the money because of all sorts of logic the price will rise, whereas declines that we have discussed before. Since market movements are inherently uncertain and can't be predicted accurately, what is the purpose of technical analysis for trading? Bullish versus bearish, right? It's better to say nothing than to do nothing. The answer is right at the beginning of each of my videos. We study technical analysis to find a fleeting advantage in a murky market, right? And that advantage refers to the combination of win and loss ratios. To continue with the 3 kinds of entry logic that we just used, let's say that you're doing a price action short-term trade and you see this signal and you go straight in and you go long, and then you get a 1-to-1 break-even ratio. You have at least a 60% win rate, and the win break-even ratio of the combination is your advantage even if the trade stops at a loss, but because you have a mathematical advantage you are going to make a steady profit in the long run. And this credit K line is not so good, and if you give a better signal K line, then your win break-even ratio is going to be bigger than the combination advantage and your profit potential is going to be bigger. If you're in the trend system and you're long here waiting for a break or you're high before the back test and you're in the reverse trade, then you have at least a 40% chance of winning on a 2-to-1 break-even ratio, and even if the trade doesn't have a 50% chance of winning, but it's still mathematically advantageous to have a high break-even ratio. Although you may lose money in the short term, you still gain in the long term. The uncertainty of the price movement allows you to make money on the long side and make money on the short side under the same market conditions. Those who don't know technical analysis or mathematical advantages lose money on the long side and contribute to the market profit. All of the 3 ways that we talked about are saying that there's a high probability that the price is going to go up in the short term here, but it's behind this K line and he's doing a 5K line sideways, and then he's going to break down and he's going to crash, and there's no problem. And if that happens, it means that there's not a lot of buying power here and the market is going to go lower and look for a stronger bid. Uncertainty is the basic principle of market price movement underlying logic. We should understand and accept any trend in the market and use technical analysis to find advantages in uncertainty. Understanding the uncertainty of price movements, we know that no matter how perfect an entry is, it's likely to fail, because there's always someone in the market who thinks the opposite of what you think. There's a quote in Brooks's book that's always been a warning to me when I was trading, and I'm going to share it with you. No matter how much you believe in your own judgment, there are people as smart as you who believe the opposite, and when you come across a great trading opportunity, and you're so sure of your own judgment and you have the urge to double down, hopefully you'll remember that every form can fail. One form fails, and immediately a new one forms. For example, a simple one-stage pullback that fails with a low momentum trend becomes a two-stage pullback, and a two-stage pullback that fails again becomes a three-stage linear pullback. Now a reversal pattern failure becomes a trading band pullback pattern, followed by a trend breakout failure, followed by a contrarian breakout, and then a reversal pattern becomes an end flag reversal. These are fairly simple cases that we've talked about in previous lectures, and today we're going to look at two reverse reversal cases. If you look at the price pattern in the chart below, you don't have a problem if you think of it as a major trend reversal end flag reversal. The point is that we see a reversal pattern that has led to a contrarian breakout, and we measure the price movement at the height of that pattern, and then we break out and we do an isometric extension, and we're going to take a conservative height and we're going to measure the vertical distance between this high and this low, and we're going to do an isometric extension down to find a horizontal level. This price level is our ultimate profit target. Why not take the two furthest apart bands high and low to measure? Because these 2 points are so far apart and there's such a long uplead at this high point, we figured we'd better be conservative with our profit target. If you look at the follow-through, the price breaks through the double top pattern, the breakout point of the pullback continues the decline, but the decline fails to continue the short momentum. The double top reversal pattern turns into a double bottom correction, and right at the time of the reversal, which is fairly common in trading, you see the counter-trend breakout and you think the reversal pattern is finally established and you can make a big deal on this trade, and it turns out that the reversal pattern turns into a correction pattern very quickly, and it's very difficult. You can't help it because the major trend reversals have a low success rate. If we look at this case again, where we have a simple head and shoulder shape and we have broken down, we draw an isometric target of the shape and we find a head and shoulder profit, and the final profit target is here. If you look at the subsequent action, the reversal pattern of the head and shoulder top, instead of a true reversal, turns into a wedge correction, and the wedge is indicated by the red line segment, indicating that the selling force in the market is not much stronger than the buying force after the break in the head and shoulder top pattern. We may not be able to get to the root cause of this phenomenon, but that's not important. The important thing is that the graph tells us what the long-short game is going to look like, and we're going to do something about it. We don't know exactly what's going to happen in terms of patterns, and the whole point of trading is the game, and if you practice over time understanding and accepting the uncertainty of price movements and becoming adept at recognizing changes in patterns, then you're ahead of most of the traders in the market, but you're still short of a steady profit. And finally, your strategy in a changing market is order management. Only a few trades go as expected when we come in. Most trades come in and your position is very variable, and your ability to deal with it determines your level of trading. But order management is a big subject, and we'll talk about it in a few words, and we'll talk about it later in the course. And here's a way to think about it from that point of view. I believe that there will be friends themselves will be able to understand their own order management. The setting of a stop loss after entry depends on their own trading system. To directly hit the execution of the stop loss, that this situation does not need order management after all. After you enter, not long after the automatic appearance. 3. Entry after the market horizontal. For entry after the price to stop the target movement not far away and reverse. The 5. Entry price plays a stop loss but immediately gives a good second entry. Why is order management such a complicated subject? Because different types of traders, radicals and conservatives, use different types of trading systems to invert the trend interval in the long and short bands. Their order management strategies are all different. There is no right answer to this subject, but everyone has to find their own way. So let's think about what you would do if you were making a deal and you ran into some of these problems. And I'm going to give you some ideas for the rest of the course as you understand and accept the uncertainty of price movements, and you become adept at recognizing patterns, and you develop your own strategies for dealing with them, and you're on the path to a stable and profitable trade. And finally, just a couple of things, and the nesting of morphology and structure that's easy to understand. A large structure that contains a small pattern, such as in a large trading band, the way you move from the bottom of the range to the top of the range is a 3-push wedge, and when you do the upper, lower, and higher part of the range, it is the same as doing a 3-push new inversion entry, in which one entry verifies multiple forms of logic at the same time. Another example is making a small head and shoulders reversal pattern at the top of the range. Again, your short entry validates multiple forms of logic at the same time, and it's a comfortable trade to make with a high win rate. It is easy to identify the form nesting in the trading range, but it also exists in other market conditions. If you can find it, you can catch the trading opportunities with great advantages. Technical analysis is not omnipotent, and it also has its own limitations. In the market value is very low, the main height of the control market technical analysis is not very effective. After all, the main height of the control market K-line, it wants to draw how to draw retail, and main retail is completely opposite of any advantage. If you like to participate in this kind of market, I teach a lot of things will not be used. But there is also a technical analysis for this species, which is to look at the pattern of harvesting and distribution, which is very simple if you learn the things that I taught you. And if the market suddenly explodes and dries up, technical analysis is basically useless. The outbreak of liquidity generally refers to the shock on the news surface, the sudden emergence of major good and bad news, the sudden emergence of a large amount of buying and selling power in the market, resulting in insufficient counterparties to absorb the liquidity shock in a short time. It is easy for the price to instantly break through all the technical forms of small cycles and stop at the support resistance level of big cycles. Foreign exchange investors should know that when important economic data is released, if there is a far deviation from the expected situation, the corresponding varieties will instantly jump and fall by dozens of points. All small cycle technical forms are invalid. Personally, I am a short-term trader, and everyone knows that I basically do not trade every trading time in order to avoid the impact of such liquidity. The other scenario is that liquidity dries up and foreign exchange speculation is still relatively rare. The most recent one happened in March last year during the global financial crisis. Gold and crude oil currency pairs lacked liquidity. There is also a situation that there is no news impact on the simple large level of funds out of the entrance, such as institutions, to do the analysis of the daily line around the chart because of their large size. Their entry on the small cycle chart technical form is the impact of liquidity. Friends should be very familiar with the currency, such as which big guy he bought a few United States gold Bitcoin goes through the roof, and the technical patterns of the small cycle break down, and if one of the big guys he sells out and the price goes down and hits a couple of technical support levels, these big levels of money come out, and the technical patterns of the small cycle chart are liquidity shocks. Just to talk a little bit about why some varieties have gone up for years and years and decades and hundreds of times, the logic behind it is very simple, and there are two things: either there is a lack of selling power, or there is a constant buying power, or there is a lack of both. So it's okay to go up tens of times, and let's just say the difference between the two. A novice might mistake this for the same state of the market. Take a look at this. I don't know much about altcoin. This is what Mr. Luo said when he was looking for a case. This small coin has several characteristics in common. First, its market value is very low. The main team holds the majority of the chips. More than 90% of the chips are in their hands. Once this kind of variety began to pull up is no selling power because the chips are all in their own hands. The market circulation is very little, selling power is very little. How they want to pull the plate is how to pull dozens of times, hundreds of times is not a dream. Many friends just enter the market like to participate in these varieties, fantasy revenge, but this kind of variety has several fundamental problems. The first one is that they have very low volume at the bottom and you can't buy a lot of leverage, and once you buy in a big way your buying force is going to form a big positive line because there's not enough depth in the market, and when the main force sees retail buying in a big way he's going to give up on short-term pulling plans. The second point is that even if you buy in batches every day and you buy a lot of chips and you fantasize that you're worth tens of times more, you can't forget that you bought a lot of chips and you've probably taken up a lot of the actual amount of chips that are circulating in the market and it's gone up tens of times more. And once you sell it and it's close to the main selling effect and it's normal to see tens of times more float and you sell it and you lose 30%. The third point, I made both of the first 2 points on the assumption that it's going to go up like this, but in fact, because it's the main height control, it's the main force that decides whether the price goes up or not, and if they don't want to pull your position it's normal to sit there for a couple of years, and if it goes up, it's the main force that decides where it goes up because they own the lion's share of the chips, and when they ship it's nothing. The other day, you're in the middle of an amazing experience with a big float and feeling like you have a good eye for a good variety. And then the next day, the price drops to a point where you can never get out of it, and then you regret that you didn't sell up and you don't want to cut the meat, and then the price goes down and you regret participating in the market until it goes to zero, and it's not a joke. When it comes to zero, the first thing to go to zero is very common in a highly controlled breed like the coin circle. The main players hold more than 90% of the chips. And when they distribute all these chips to the market, how do they get the money to take up the deal? The logic is simple enough. If you look at the next example, this is the weekly chart of Matai and this is the weekly chart of Apple. These two varieties have also gone up more than 10 times over a long period of time. What's the difference between them and altcoin? First of all, they are the leaders of their respective sectors and they have very high market capitalization, and second of all, because the regulatory mechanism of the stock market doesn't allow one institution to have a high degree of control in these markets, and there are a lot of institutions that are fully engaged in these markets, and third of all, there are a lot of retail investors involved in these early days. Why can such a variety also increase 10 years in a row tens of times? It's very simple, because there are persistent buying forces, institutions or individuals, and they keep buying for a variety of reasons, whether it's the policy direction of the country, whether it's the outlook of the industry, or whether it's the technology shape. What about last year? Because of the global financial crisis, central banks all over the world were pumping out money, and all of that liquidity went into these stocks, and anyway, there was a constant buying force that was going to sustain the bull market. And you didn't have to be as scared as you were when you wanted to buy, how much you wanted to buy, when you wanted to sell. If you sell it for a few billion, you can sell it for a few billion. Last but not least, some friends ask why it is so easy for you to read the graph and find the key patterns and signals, K-line, to make a trade, while it is so easy for me to read the graph slowly and I can't find the key information to make a trade and I have no confidence. I answered this question in the previous video, and this is actually the result of the difference in trading experience. The reason why I brought this question up today is that recently a friend of mine visited a real trader friend who was traveling from Dali to Shanghai, and we discussed a lot about trading experience together. His first teachers in trading were Livermore and Albrechts, who also specialized in short trading of FX 5-minute 15-minute charts, so our trading system is very similar. It has two main systems: moving average combination naked K price behavior. Entry signal is different from my system, but the entry logic is the same. But even with a similar system it trades with a 1:2 to 1 break-even ratio of 75%, losses of 10%, and the rest of it is break-even, which is an amazing trading statistic that I wouldn't have believed if I hadn't seen it with my own eyes. That he made a $500,000 trading account with this system and made an average profit of $150,000 to $200,000 a month. And this is a level where compound interest stopped 2 years ago, and it would have been unimaginable if compound interest had continued to grow. The reason why the trading level is so much higher than mine is because of the difference in experience. The longer you trade, the more you trade, the more experienced you are in reading graphs, and you can tell which signals are more advantageous in the same system opportunity. What signals are not worth making is a subjective trade-off, and it's more natural for him to make a deal, in his own words, reading the K line and making a deal, there is not much to think about the management of exit orders. So I think a novice can make stable profits from just starting trading to becoming a master trading and gradually accumulate wealth to eventually becoming a master to realize wealth freedom. Every step in the middle is the accumulation of experience. I did not mention the problem of trading discipline. Some friend said that he could not control his hand, knowing that he could not do anything, but could not help manipulating and losing money. I don't know what to say about that because I think discipline is a fundamental condition of doing business, and without discipline, you can't make a steady profit, and that's a very simple truth. So for me, it's just execution, and I don't know why a lot of people don't follow discipline. Friends with this problem can find books on the psychology of trading or learn from the design of trading system to avoid losing control. For example, for me, a trade hits my stop loss immediately gives me a good second chance to turn, so I will not do it. This kind of entrance is easy for my bosses, so I just eliminated it when the system was being designed. Okay, so that's it for today. It's a little bit overdone and it took a lot of time to prepare for this video, and thank you all for watching. Please consider like, comment and subscribe. Also don't forget to follow us so you watch the following updates as fast as the video upload. Bye.